consolidation, expansion, retracement, smacking back into this range, and expansion again. These PD arrays, this inverse order block, these are all confluence levels with the consolidation. I don't care about them. They come secondary, but the consolidation, expansion, retracement, expansion is what matters more to me. Next up, how would one go about trading this model or any time-based model? Of course, with the demo money, if you so wished. Because that's another important observation, which is teaching analysis versus teaching execution. In this one, I'm teaching you analysis. Execution is a topic for later. Number one, or step one, determine higher time frame directional bias and narrative. Bias is where and narrative is why. 2, mark out the midnight opening price before opening time before midnight arrives. Mark a potential key level, which will mark the high/low of the candle you are willing to trade. Mark a liquidity pool. More on this in the upcoming chapters. Mark the CBDR/Asian range/flout standard deviations to approximate an area of the low of the candle or high of the candle to happen. Standard deviations are a good tool, but they are not. Again, they're all subservient to the element of time and the higher time frame key level, which always has a liquidity pool paired with it, right? Wait for your pattern, and you see when the pattern happens. It's not look for an order block. It's look for all of this and then an order block. It might seem like much to do at the beginning, but it becomes second nature, like driving, right? At first you're looking at the mirror, the side mirrors, and the rear view mirror. You can't talk while driving, right? At the beginning, but eventually it becomes second nature, all of that. And for those who drive a manual, which is more fun, you will also understand the learning curve of anything, of any skill. Number 5 is wait for your pattern to form below the opening price after the protraction has happened. Number 6 is memorize and write down your observations. If you're right, note and repeat. If you're wrong, note and avoid. And if you miss, note and catch it next time. That is the importance of a journal. It's not some diary, right? And I don't journal much outside of my patients and my trades. I think it's a waste of time, but in trading it is an absolute must. So that's the idea: is opening time, key level marked out beforehand over here, protraction, expansion number 1 happening at this time, OTE, and then expansion number 2. The OTE means that a swing high will form, a predetermined swing high will form within the daily candle, smacking into the 1 hour candle, the 1 o'clock candle, excuse me. All right. This right here is the highest, if it's confirmed up here, then this is the highest probability trade you will take, even higher than this, because if there is one expansion leg, then it's very likely that you have another expansion leg due. If you have an expansion leg that broke market structure and shifted it, right? You see a high, low, higher high, and you break the low that broke the high with a massive swing, and there's a high chance there's another massive swing at least the same size, which is due. Procedure to show you how it's visually done. And I've never spoon-fed this much in my life. But the procedure is as follows. Number one. Step one is determining the higher time frame directional bias. Candle number one, candle number two. If candle number two has taken the low of candle number one and has not closed below it, then there is a high chance that it retraces to 50% of candle number one and 100% of candle number one. So Monday, Tuesday, Wednesday. 3-candle model for those who have attended the previous one, time and turtle soup, level 2, on the website. Shameless plug, yes I know, but it's really important. That is one of the most important lectures I've produced ever, and I cannot recommend it enough. The stuff in that lecture is actually, there are some things in there which I never intended to release to the public, but I did anyway. And the fact that I'm even reminding you that it exists, I'm slightly hesitant. However, it is crucial, which is why I'm reminding you. If you haven't got level 2 and you can, then get level 2. It's on the website, link in the bio of Twitter. So candle number 1 is over here, Monday. Candle number 2, Tuesday. This gives me a directional bias for Wednesday. Pair with that the fact that Wednesday has a high chance of being a classic buy or sell candle in the direction of the weekly and daily order flow. This gives me an excellent opportunity for a potential trade. So you have Monday, you have Tuesday, and you have Wednesday. Before Wednesday opens, we keep in mind that every midnight is a new opportunity. We have it marked. We have this rejection block marked. If we have long wicks or even stubby wicks for the order block, then this is swing high, and swing highs are usually good stop losses. Therefore, we mark the rejection block, and of course, the 1 o'clock candle produces the low, and the 9 o'clock candle produces the OTE. Accumulation, manipulation, consolidation, expansion, leg number 1, retracement, expansion, leg number 2, the order block to the pip, the opening price. And I have something very important to speak about regarding opening prices and closing prices in the next chapter. Consolidation, expansion leg number 1, retracement, expansion leg number 2. A very, very high chance that there's another leg after the market structure shift. So low, high, swing low, break the swing high, that broke the swing low, that caused a turtle soup. This high that caused turtle soup is broken with a massive expansion wave. There's a high chance that there's another massive expansion wave due. Add to that the fact that this long-wicked candle was disrespected. This wick is going to be used as the mitigation level, which smart money will use to mitigate their positions. And yes, they mitigate the positions. Price doesn't mitigate anything. That's a pet peeve I have, which is when people say that price mitigates. It doesn't. Traders mitigate their positions. Price doesn't. Rain's theory commentary. When the daily high and low are formed, then on the 15-minute time frame, you will find a range being souped. All right, this is 3 o'clock. That's one thing to note right now. If you're getting lazy, then snap out of it. and write down that in your notes, which is the daily candle, the high and the low will form with a 15-minute range being souped at the high or the low. Another thing is this Monday range. This is a classic Monday low to high model, right? That is by itself a time-based model, which is discussed in depth in level 2, the advanced version. The basic premise is Monday, Tuesday takes out the low of Monday, does not break below it. It's a false breakout, seen by the number of closes and the lack of intention, the support as an idea. Smart money is supporting this low. It's sponsoring this low. Therefore, we can safely assume that Wednesday will take out Monday's high, or even Thursday. If there's a news event which will restrict Wednesday, then Thursday will take out Monday's high. That is how you also extract a directional bias on one time frame. Pattern traders, they saw this market structure shift and they were buying all the way down. They got stopped out, and then market went to their objective, right? So don't be a pattern trader. You see the difference. I'm not even looking at the pattern. I'm looking at the highs and lows, the market profile, and the ranges. The market profile broke the high. Okay, fantastic. But now we're rejecting this high and breaking this low. The profile on this time frame has changed, right? If you can trade one time frame, although I always advise my mentees against it when they ask. You can, but you shouldn't, right? But if you want to, at least do it right. Market profile, a high being broken, okay, we're bullish. However, now that idea is being negated by this rejected high. This rejected high gives you an insight into what smart money is doing. They are refusing to sponsor this high as a breakout. They're using this high to pair orders. Everyone's buying up here, right? OTE buyers all up here. And using that against them, it is confirmed when they break this low. The low that broke the high. Or even this one, right? You see lack of intention of smart money to sponsor the lows and an intention to falsely break above the highs. Market profiling. That is, in summary, market profiling. Checking the highs and lows to see what is smart money sponsoring and what is smart money using as a pivot point to false breakout. So yeah, this open range, pre-opening range, soup, breakout, leg number 1, expansion leg number 1, retracement, expansion leg number 2. It's that simple. Consolidation, expansion, retracement, expansion. Leg number 1, leg number 2. Wednesday, classic buy day, right? That's the end of it. If you focused on catching 4 of these per month, instead of trading every single 1 hour candle you see, then you would have a much more successful career as a trader. That concludes chapter number 4 and 5. I hope you found it insightful. It was packed. And I wish you good luck and good trading, and see you in the next one.